Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, I'm going to be talking about my experience and what I've learned over the last 10 years with investing. And that is because recently I turned 27 and I started investing when I was 17. So I figured this would be a good time to talk about what I've learned. So it all goes back to senior year of high school when I was 17 years old. And in my economics class, we pretty much did an exercise where everybody would pick like five stocks or whatever to keep track of during the course of the semester. So I forgot exactly what stocks I picked or if they performed well or anything, but basically we did this exercise and then at the end of the semester, that would have been December of 2017. No, I'm sorry, December 2016. Then that's when I graduated from high school because I was a semester early. Then in January of 2017, I emailed that teacher and said, "Hey, I'm interested in learning more about stocks. What platform should I use and all that stuff." And I actually just went back and read that email. I still have the email, and my teacher responded and said, "Here's a couple different platforms you could use: E-Trade, Scottrade, Fidelity, all these different ones." She said, the one she normally uses charges $8 per trade, which is insane to think about now because we've been doing, commission-free trading has been available now for, a number of years. But 10 years ago, that was more of the standard was you had to pay five or ten, at least $5 or $10 every time you bought or sold a stock. So I can't even imagine having to do that today because that would have been that would probably have added up to thousands of dollars of money that I would have wasted on just trades. So there is that piece. Anyways, I decided to go with Robinhood because Robinhood was still new at that time, but Robinhood was also coming out with the, free no commissions, pretty much free trading. So I made a Robinhood account. Keep in mind, I'm still only 17 at this point because this is January of 2017. And I had to use my mom's information though. So I went on my mom's phone because I wasn't 18, so you can't make an account. So I made an account with my mom's information. And then right here, I have a picture of my first investment. So as you can see, my first investment ever was January 24th, 2017. I bought this pharmaceutical company for $18.31. That was my first investment, $18. Then a couple weeks later, I sold it at a huge profit of $18.32. So I made a 1 cent profit on that trade. Very nice. I'm very happy with that trade. Then I also invested in Ford around that time, $25. I ended up losing 4 cents on that trade. So not the best, but I was learning, right? So that was my first experience with investing. And right off the bat, $18 is my first investment. Okay. It's not, people to this day still think that you need thousands of dollars to get invested. It's not like you're, opening up a hotel franchise or something. You could literally start with $1 and buy a stock. That's all it takes today. So then, what happened? At that point, then I went on YouTube and I started just researching stocks. I came across this channel, Financial Education, and if you know Financial Education, you know that Jeremy is the one who makes those videos. And to this day, I still watch his videos. It's been 10 years, and I still watch his videos. And that's where I learned everything. I learned about, he taught this Warren Buffett style of investing where you look at the PE ratios, look at the moat of the business. Do you understand the company? Look at the financial statements, all that stuff. So that was my introduction to investing. Have a long-term mindset, don't do day trading and stuff like that. And I was even at 17, I was immediately drawn to that style of investing. I knew that was the more proven, consistent, trustworthy model. And I knew that was how people like Warren Buffett and, these other investors got rich was from this long-term strategy. So I did that and I probably kept buying whatever, I don't know, Amazon, an index fund. I was probably buying Facebook and who knows what Google, who knows whatever else was popular in 2017, 2018. Then I did that for whatever until the next couple years. And then my next milestone was 2019 when, of course, I was watching Jeremy all the time. He was preaching about Tesla like crazy, right? So I really bought into that. And that was 2019. I made a position in Tesla. I kept buying Tesla shares because the stock was falling. I remember I was getting it at like it was like a 25 or $30 billion company back then. And so I kept buying shares. Jeremy made this point where Tesla was going to be this huge company and sell a million cars a year at some point in the future. And I always thought, oh, wouldn't that be crazy if this actually panned out and Tesla, did become this company that 10x their market cap and 10x their earnings. So I bought that 2019, 2020. I remember at that time there was nobody bullish on Tesla, right? The only people were Jeremy, the channel Hyperchange, which I still watch his videos too. Kathy Wood from ARK Invest, and then Ron Barron was also bullish. Those are the only people pretty much on the internet I could find that were bullish. Morgan Stanley, I remember, put out articles saying Tesla is going to $10 a share. That's our price target. And really looking back, so I put a good amount of money in there. Okay, I put a decent fraction of a good part of my portfolio was allocated just into Tesla stock. I would never do that today, especially with a company that's losing money and is some electric vehicle startup that is definitely a risk. So, anyways, I did that. And then 2020, and I forgot exactly what my market returns were like at that time. I don't think it was bad. It was probably somewhere around what the index was doing. I was probably making whatever 20% a year or 25%, 30% a year. And I remember certain stocks 2018 and 19, I was buying probably stuff like Uber. I was buying Nvidia. I was buying Square, which is now known as Block. But I was buying those companies, and I remember or Alibaba's another one. And I would definitely get into the habit of like I'd buy a stock, and for a lot of those, most of those years, the market did good. The market was going up most of the time. So I would make 20 or 30% in a month or a couple months, and I'd be super excited about that. And then I'd take my profit, right? So that's what I did. And, and looking back on a company like Nvidia, where I would have made literally like over, 2000% or something on my money versus 30%. Some of those stocks would have been nice to keep or hold at least a little bit longer, but I didn't. I was, excited about my profits and whatever. So, anyways, then 2020 happens. Everybody knows what happens that year, and the market crashes. My Tesla position goes negative. Keep in mind, this is a double-digit percentage of where my money is allocated. Okay, so it's a good amount. Then my Tesla position goes negative. I start getting, I think my account actually went negative from where I had started even 2 years ago. So I was definitely getting concerned. I was like, wow, what if this Tesla, what if I'm wrong about this Tesla? Because at that point I was super bullish on Tesla. I said, what if this, thesis doesn't play out? And then, of course, that was one of the most historical moments where the market crashed, and then it was like the fastest return of all time because it crashed in March, and within like a month or two, we had already started going back up, and then that rest of that year was just up, up, and away. And then I started making money on Tesla. That was an important time for Tesla as a company and Elon Musk in the news and everything. Then we go into 2021. That's when Tesla peaks out, and the market cap goes to I don't even know how much. It went to close to I think it went to $1 trillion or something like that, or it was at least 800 billion. So I'm up over 2,000% on my Tesla position 2021. I don't think I might have sold some shares. I don't know though. I think I waited at least another year or two and then sold my shares. And well, actually, no, I did sell a lot of I sold at least half of my position, I think, in 2021. Because then what happened was 2022 was a bad year for the market. And that's when I lost a ton of money. I lost at least half of my account. Well, that was because all the profit that I took from Tesla in 21, I put into these Kathy Wood stocks in 2022. Lost a bunch of money. A lot of them did not recover. Go back to PayPal. This is Block. There's certain companies. And so I lost a lot of money that year. I still had some Tesla though. I did have some Tesla. And then 2022, going into 2023, I moved the money. I took some losses and then I put some money in new stocks and I made some money back. I ended up making at least half of my money back. So not all of it the next year, but at least half of it. And I was still up big from where I started 5 years ago, right? So that's 2023. That was a good year. 2024 was a good year. 2025, this past year now, you can see I'm up 58% from where I was buying. This is now, here's the other preface to this story is Robinhood is my main account. It's not my only account. I also have a Fidelity account that I opened maybe 4 or 5 years ago. But this past year for this account has been phenomenal, up 58%. The QQQ is up 40, what? 47% or something like that. So these last couple of years I've been really good with 47%. So these last couple of years I've been really good at beating the market. I've done the math multiple times, and in the last 9 years or so, I've averaged a 30% annual return. So I'm super happy with that. And so that's where I'm at today. Now, I would say um, 2022 was definitely an important learning year for me, because 2022 was when I lost all that money, and I realized, okay, some of these companies, DocuSign, that was another one. You have to, Kathy. I thought, oh, because Kathy Wood got Tesla right, that she was going to be right about these other ones. Well, that wasn't the case, because you go back, Teladoc Health, that's another one. You look at those companies, they did not recover. Okay, so that was a big learning year for me. And then I would say after that, 20 in 23 and on, I've become a more safe investor, a more careful investor. And I've learned a lot, not just about what stocks to buy, or how many stocks to own. You can see now I own like almost 30 companies, but it's not just about what stocks you own. Um, all of that is very important. It's also about how do you buy and sell. I've kind of adopted, I've grown into this method now where when I buy or sell, I try not to do it all in one piece. Just, buy or sell the whole position in one piece. That I don't really do that. I normally will do it a couple shares at a time, right? Or I'll put, I'll buy, maybe I'll buy $1,000 worth or $2,000 worth, and then if it drops 20%, I'll go in and buy another $1,000 or $2,000 worth. That's kind of how I do things now, and it's better, it's safer, it's just a better strategy. Same thing when I sell a stock. I try not to sell. I did this with Tesla. I did this with a lot of companies. Again, because I learned my lesson over those years. With a company like Meta, Meta has been one of the most important companies in my investing history, because Meta has almost always been a significant position for me in my portfolio the entire time. I've probably been investing in Tesla now for at least 8 years. Or I'm sorry, not Tesla, Meta. I've probably been investing in Meta now for at least 8 years. And it's made me a lot of money. I've made money with the stock multiple times. But there was a time when the stock went from, I think I wrote it from like $100 to when it went to 350. This was right before they started getting heavy into the metaverse. So this was probably 4 or 5 years ago. Right before they went to the metaverse, the stock was at $350, and I was up. I think I was up at least 100. I had to be up at least 100%. And then what happened? The stock crashed and went back down to $100. And I'm like, wow, I just waited all. I've been holding this stock for multiple years, having this long-term mindset, and Meta's a great company. And now I could have literally sold at any time and made, a couple $1,000s of profit. So I didn't do that. And that was kind of the lesson I learned of when stocks start to, when they run up for a long period of time, or you're up a big amount, or the valuation's high. You don't need to sell the whole thing. You can if you really think it's overvalued, or you really are done with the company. But even if you want to stay invested, sell some of it. Sell, 20%, 30%, 40% of your position. So that way you lock in some profits. And then if the stock keeps going up, well, okay, then you sell more, or you know what I mean, or you could keep holding if you want. But then if the stock goes down, you say, okay, well, at least I took some profits at the top, and now I have money in my account, including my initial investment plus the profit, to invest back into the company at a cheaper price. So it just works out better that way. What else do we got here? I mean, like I said, I got 25 or 30 stocks. As you can see now, I have a lot of software, because software has been dropping. I have, Uber, Nike, Salesforce, Adobe. I always try to build my index position pretty large. Right now, I actually want to put in a lot more than what I have. Right now, I have 25,000 or whatever in here, and I have 30,000 in cash in this account sitting on the sidelines. I would like to have all that in the QQQ. The problem is it just hasn't dropped far enough. I mean, I was expecting the QQQ to go like to $500 or below, and it just bottomed right there a couple weeks ago, and then now it's been up and away. We're at a new high. So who knows if this is going to last? I don't know if this is going to last, but if we go below 500, I'd like to put all this money into this. But so that's just kind of my philosophy with this. As for like how I judge things, I use Qualtrim a lot. Okay, so Qualtrim is a subscription based thing. You have to go to Joseph Carlson's Patreon, but I use this just because I like the charts. It's got lots of good information. I like how everything's laid out right here. So I use this, and then I use Yahoo Finance to look at analyst estimates and the PEG ratio and all these different things. So those are two of my main platforms, and then I will, search it up on Google and see what's in the news, and then I will look at uh, Gemini and Claude to ask them what they think. And then there's websites like this where you can get insider information or super investor information. See what stocks are they buying. So if we look at this past quarter here, we can see that the stocks that are being bought the most are. Hope it's not Icon. Maybe that's it. Okay, so what is there? Maybe there's not a lot of buying. So, anyways, these are the websites I use. Okay. And other than that, I would say, watching YouTube videos, reading books. I read The Intelligent Investor a long time ago. That was, again, I was pretty focused on Warren Buffett and people who invested like him, Peter Lynch. And, I like Ray Dalio. Those are, a lot of the investors that I like. And then I try to, if you stay in big names like Amazon, not all big names, I'm not talking about like, if you look at Walgreens or you look at even Nike and Disney, they haven't been good. But if you look at companies that are like the Mag 7 and stuff like that, Amazon, Meta, I don't know, maybe a Netflix, definitely a Microsoft, Google. I like Taiwan Semiconductor a lot. I like ASML. ASML made me a lot of money last year, stuff like that. Then stuff like Amazon, Microsoft, and Google. Those are pretty safe plays. When those drop, those are always a buy for the foreseeable future. And so that's really it. That's been my story. And as you can see, I learned a lot over that period. Tesla was my best investment. Again, over 2000% gain on that one. That one's going to be hard to match that ever again. I don't think you can ever, I don't think I'll ever get another investment that makes me over 2000% return. But, like I said, Meta and some of these other ones have also been fantastic players. Elf Beauty made me over like 100% last year. Taiwan Semiconductor 100%, Google 100%. It's not that hard to make 100% on a stock when you're in a crash, when those stocks crash. So look out for the crashes. When those happen, buy up some stocks. And if you just want to, like Warren Buffett always says, just buy an index fund. I choose the QQQ over the S&P because the QQQ it outperforms, okay, 90% in the last 5 years versus the S&P has done 70%. The Nasdaq pretty much always outperforms, but either one, I mean, I think the Nasdaq you're going to make more money, but so I would just, if you want to play it safe, you just want to make money without worrying about it, just buy this. That's all you have to do. That's really all it is. I mean, this has always made a new high, So, oh, here's another one. I go to Yardini Research. This one's a pretty good website showing lots of graphs for PE ratios and stuff. Like if you look at this will show you the history of Mag 7 and the S&P stocks and where we're at valuation wise, which right now we're like kind of right in the middle. I think the market right now is going through this weird transition phase where they don't know how to value stocks. And with AI, affecting everything, the job market, the way businesses run their business and the economy and all this stuff, I think there is a re-rate. Definitely, we've already seen it with software stocks and financial stocks get hit hard. But I think just in general, it's going to just reval. It's going to make everything get revalued. So we'll see what happens with that. Maybe it could. I don't know. It's hard to say. It could make it where unless you're an AI company, that you're going to trade at a lower multiple. And if you're an innovative AI company, then you're going to trade at a high multiple. Look at Palantir and Tesla. I'm not saying all stocks should trade at 200 times earnings, but those stocks are, you know, in my opinion, they're overvalued. But I think investors are buying those up, and the sentiment is so high on those because they know they're innovative companies that are utilizing AI to capitalize on the future. So that's pretty much it. That is my story with investing. And if you have any questions, comment down below. You could also message me with questions, but basically that's I think every single person should have a brokerage account, whether it's Robinhood, Fidelity, whatever, and buy the index. That's all you have to do. Just buy the index fund, and then if you want to individually pick stocks, you can. I don't really think it's necessary because it takes a ton of time and effort, and you're lucky to outperform the market. I think it's more important about timing it almost like when the market like you could just dollar cost average just buy every month and that works. You're going to make money. But if you want to kind of lean into when the market crashes, like try to buy when the market's down over 20%, try to buy more than usual. And then when the market is priced super high and everything is just off the wall, where it feels like we're in a bubble, then I guess you could still buy, but maybe just take it easy. Like also have cash on the sidelines and don't be surprised if it drops. Right now, with the market hitting an all-time high, again, it could keep going for another year or something. Another year, maybe, I mean, maybe even 2 years, the market could keep going. Personally, I don't think that's going to happen. I think we need another little crash. But again, it's always funner when the market just goes up and you keep making money every day. So that's kind of my viewpoint on that. Otherwise, if you want to buy individual stocks, you could there's different strategies with that. Some people like the dividends. Go ahead and buy the dividend stocks. Just be careful, it's not a risky company. Dividends are not the best thing to chase, if I'm being honest, because a lot of companies use that as a trap, where especially if you see a company that has a 5 to 10% dividend, a lot of times that's a trap. It's usually a trap. That means they have a bunch of debt and they're not making enough money, or there's some issue there. They're going to dilute the shareholders and keep increasing shares outstanding. Something usually it's a red flag. Um, Other than that, I mean, again, like I think buying Google and Microsoft and Apple and Amazon, those the big famous companies, that's a pretty safe bet if you want to add those in with the index fund. If you want to buy penny stocks or little companies or risky companies, all I could say is make it a super tiny position of your thing. So if you only got $100 to invest, maybe put like $1 in there, but don't make that 10% of your portfolio. I definitely wouldn't do that. So that is pretty much it. Let me know what you guys think, and I will see you in the next video.